Hi everyone. Okay, let's continue. But I did back up a couple of steps because I realized that by having my picture on the screen, it blocked some of the information. So sorry about that. So let's have a look again. So as I mentioned in the previous video, with the owner investing $10,000 cash into their company, again, it has to balance. The equation has to balance. So we've got assets on one side, and we got 10,000 in cash, so it increased our assets. On the other side, is it a liability or is it an equity? It's an equity because the owner invested from their own pocket into the company. So equity goes up by $10,000. Okay, so now something actually happened. So a transaction um, involving buying something. Okay, so they purchased supplies for cash. So in this case, two things happened on the asset side. Okay, cash itself went down by 2,500, but supplies went up by 2,500. So even though the balance didn't change on the liability and equity side, it's still $10,000. Assets are still $10,000. We just kind of traded 2,500 worth of one asset for 2,500 of another asset. Okay, so for this one here, again, we've got supplies of 1,100 and we bought equipment or a food truck for 6,000. So let's deal with that. Asset side, supplies go up by 1,100, equipment goes up by 1,100. You add all that together, and we now have assets of 17,100. Okay, how does it affect the other side? Total liabilities to canned food supplies is 7,100. Okay, so how will this happen? We'll pay for the supplies in 30 days. So because we know we're going to pay for the supplies within 30 days, it's an accounts payable. Okay, so our accounts payable, what we're due to pay in the very near future is 1,100. But for equipment, we actually got a type of a loan. Okay, so that goes under what's called notes payable for 6,000. But again, it still increased our liabilities by 7,100. So the 7,100 plus the equity of 10,000 is 17,100. So again, our equation still balances. So now we have revenue. Okay, services rendered. So Organico provide catering service for a company, and they sold $2,200 worth of burritos for cash. Okay, so we gave them burritos, so that's our revenue. And if you remember, revenue is on our income statement. We add up our income statement, revenue minus expenses gives us net income. That net income goes on to our statement of changes in equity, so it directly affects our equity. And it's the revenue that is the positive number, so our equity goes up. If it was an expense, expenses cause our net income to go down, so it would cause our equity to go down. So in this case, it's revenue. So we've got an increase in our equity of 2,200. What's the other side? They gave us cash of 2,200. So again, adding those together, we now have 19,300 on each side of our equation. Now we have two expenses and they're both paid with cash. Okay, so we've got rent. So again, as I mentioned, our income statement becomes part of our equity statement, right? Revenue minus expenses gives us either net income or a loss. Or, sorry, net income can also be, another word for net income is profit. Okay, and I think your textbook refers to it as profit. Revenue minus expenses is profit, but if your expenses are higher, it's going to be a loss. So in this case, recording these two transactions for expenses, they're going to cause your equity to go down. So we need to subtract 1,000 for our rent and subtract 700 for our salaries. And the way we pay our rent and the way we pay our salaries is from our cash account. So cash also goes down by the 1,000 and goes down by the 700. Add up what our total assets are now, add up what our total liabilities and equity are now, and they're both 17,600. Okay. Service contract signed. The accounting club at the local university and Haley Walker signed a $2,700 contract that requires Organico to provide food for a group of graduating students at their CPA recruitment event. Nothing happened. No transaction happened. They just signed an agreement that they'll do something for later. So nothing has happened. Okay. So in this case, we have Organico taught a Mexican cooking class at a team building for 300 and sold an additional 1,600 in food services at the HR conference. The group's coordinator is billed for 1,900 for both services. Okay, so it's revenue. So we've got two different types of revenue. We've got a teaching revenue for 300 and we've got a food service revenue for 1,600. And again, revenue causes your equity to go up. So we're going to add both of those to our equity to give us a total equity of 12,400. But they haven't paid us yet. They haven't given us cash yet, but they're due to pay us in the near future. So kind of like what we talked about in the previous video about accounts payable, where we're due to pay the accounts payable in the near future. Accounts receivable means that customers owe us money. So we're due to receive that 1,900 in the next 30 days. So our asset called accounts receivable is going to go up by 1,900. Okay. Receipt of cash on account. Okay, so they've now paid us the 1,900 that the customer owed us. Okay, so we received cash. So again, what happened in this transaction? We received cash, so therefore the customer doesn't owe us anymore. So we're going to reduce the accounts receivable because they don't owe us. We're not due to receive any more money because we just received it. So our cash goes up by 1,900, but our accounts receivable goes down by 1,900. So again, two assets have changed in the opposite direction of each other. So nothing happens on the liability and equity side. But we still balance because one asset went up and one asset went down. So we still have a balance on our assets of 19,500. And our liabilities and our equity is 19,500. Okay, so payment of accounts payable. So we owe 1,100, okay, but we're going to pay them 900, okay. So our accounts payable goes down by $900 because we don't owe that amount anymore. So our total accounts payable now is 200. The reason we don't owe that accounts payable anymore is because we gave them cash. So our cash comes down by 900. Okay, so add up our assets again. Now we have total assets of 18,600 and we have liabilities of 18,600. Okay, so withdraw of cash by owner. So as I mentioned before, and as we saw on the statement of changes in equity, when an owner withdraws cash from the company, it directly affects the statement of changes in equity. Because again, it can't hit the income statement. The owners are not allowed by law to list themselves as wage expense or salary expense. It has to come directly out of the equity as a withdrawal. So in this case, Walker is withdrawing $600 in cash for their own personal expenses. So it doesn't matter to us, the company, what Walker does with that money, just that they've taken the money out of the company. So equity comes down by 600 and cash comes down by 600. So therefore assets equal 18,000 and our liabilities plus our equity equals 18,000. Okay. So that is your first introduction to handling transactions within a company. And that is going to be the main focus of our next chapter, chapter 2. So if you're still a little unsure or fuzzy on how all this works, please feel free to watch the video again, and the SmartBook exercises activities should definitely help in your understanding as well. Thanks, everyone.